Well, hello, colleagues. Again, good afternoon. So it's a great pleasure to welcome you all to this Andrew Crockett Memorial Lecture. As you know, this is a biannual event, biennial, not biannual, biennial event, held since 2013 to commemorate Sir Andrew Crockett, the bank's general manager from 1994 to 2003. Andrew was a pioneer in the field of central banking and financial stability, and with these lectures, we remember his very important contributions. So let me just say that this lecture will be recorded and published on the BIS public website for viewers later. And in this occasion, we're extremely honored and happy to welcome Maurice Obstfeld. He will be talking about the international monetary and financial system, a fork in the road. Maurice hardly needs an introduction. Many of you know him or got acquainted with him through his influential textbooks co-authored with Paul Krugman and Ken Rogoff. It's now a classic in the field of international economics. He has written, co-authored, or edited more than 100 research articles and books on exchange rates, currencies, and other financial crises, global capital markets, and monetary policy. I can say, is probably one of the most knowledgeable people in these subject matters. Let me just say that the first time I met him in real life, because I studied on his work, was in 1994 after the tequila crisis. I was head of research of Banco de Mexico, and I felt that we had been run over by a truck. And we wanted to see if somebody had seen at least the license plates. And so we called on Maurice to help us figure out what happened. And of course, he was very enlightening. And he sort of let us know that it was not that the driver was reckless, more that we were crossing the street on the wrong side. But in any case, it was great to have him, and since then, he has been a great friend. And obviously, light in many subject matters. He earned his PhD from MIT in 1979 under the mentorship of Rudy Dornbusch. Beyond his remarkable academic achievements, Maurice has held prominent roles in public service, including serving on the Council of Economic Advisors during the Obama administration and as chief economist at the IMF from 2015 to 2018. Currently, he's a senior fellow at the Peterson Institute and a professor of economics at Berkeley. He has received several prestigious awards and is a fellow of the Econometric Society and of the American Academy of Arts and Sciences. So again, with this introduction, you can really sense why it is such an honor to have him with us, having Maurice with us today. So immediately after Maurice's speech, we have a panel to discuss the main issues that he raised, and we will have the privilege to hear from Andrew Bailey, from Ida Walden, and from Kazu. After each one of them gives their views on the lecture, I'll give a few minutes to Maurice to respond, and then we'll open the floor to all of you. So without further ado, Maurice, the floor is yours.
Thank you so much, Agustin. I also remember very fondly my trip to Mexico. And I just want to thank the BIS for inviting me. It's a great honor to be speaking in front of this group in this place, and especially in a a speech in honor of Andrew Crockett's memory, because I did get to know Andrew a bit in the 2000s after he moved all too briefly to California. Now, when I walk in a park, I have the habit, which annoys my wife tremendously, of reading the plaques on the park benches. And shortly after returning from the IMF in 2018, I was walking in Golden Gate Park in San Francisco with my wife and read this plaque. I was very moved because it made me remember Andrew, and I realized first, the love of his family, and secondly, how much I think he enjoyed being in San Francisco and walking in Golden Gate Park, maybe to clear his mind of thoughts of the financial crisis that was going on during that period. He lived very close to the park, so I like to imagine that he would stroll over there and take a walk, and it's a very beautiful park. Andrew, after moving to California, was not simply a retiree that was strolling around the park. He got very involved in the economics community in the Bay Area. He joined the Economic Policy Working Group at the Hoover Institution. He spoke at Berkeley, and he established personal relationships with economists working on international and monetary issues in the local community. He certainly invited my wife, Jennifer, and myself over to his home on Shadler Street in San Francisco. And he also spoke at the inaugural conference of the San Francisco Fed in their series of Asia-Pacific Economic Policy Conferences, and gave a keynote speech, in fact, at the very first conference. And I went back and read this for this occasion, and it's actually an incredibly insightful speech, like everything that Andrew wrote. He was writing about the international financial architecture, and he set out three components that he thought were critical. First, the underlying economic framework in which international economic and financial relations are conducted, the institutional arrangements that govern these market relationships, and finally, the distribution of governing power in the system. I find this a great way to think about where we have been and where we might be going. The system has evolved, of course, but looking back over the entire post-war period, until now, the foundational idea has been that trade facilitates mutual prosperity. And that's been a constant driver of the evolution of the system, until now. And what has happened now is that a narrative of grievance has taken over US geoeconomic policy. And since the US has been the center of the system, a hegemon, as you will, this is incredibly consequential for everything. There are essentially three complaints. Unfair global trade, which has given rise to deficits and deindustrialization in this narrative. We would need a much sadder song to really go along with this, but secondly, unfair global capital markets, which take advantage of using the dollar and accessing US financial markets freely, and the unfair burdens of expensive foreign security commitments, not just military, but things like aid to low-income countries. One point I want to make today is that these basic concerns are not new. They have bedeviled the US role as a leading force in the system throughout the 8 decades since World War II. But the conflictual zero-sum approach to redressing these is something new that will be very destructive. Let's look back at the Bretton Woods system, for starters, 1945 to 1973, and look at Andrew's three components: the underlying economic framework, At the start, there was a challenge of moving from inconvertibility to current account convertibility. There was a challenge of trade liberalization. The system of exchange rates was fixed but adjustable. And in terms of institutional arrangements, there were wonderful innovations, the IMF, the World Bank, the GATT. But this was still a mostly government-led system with substantial state intervention, even in the advanced economies as they recovered from the war. Increasingly, central bank cooperation helped shore up the system. And there was an extensive US security umbrella covering much of what we then called the free world during the Cold War. In terms of the distribution of power, the US was a clear hegemon, but also provided important public goods. The US had an exorbitant privilege of not having to intervene in foreign exchange markets, but it also had a commitment to redeem reserves in terms of gold. And power was concentrated largely disproportionately in the US, but in the industrial economies more broadly. In the rest of the world, there was an ongoing process of decolonization, which is an incredibly and I think often neglected aspect of this period. The dollar is actually mentioned 18 times in the fund's initial articles of agreement, the first draft of these, and it was bound to rule the post-war IMFS, International Monetary and Financial System, even without this formal recognition. As you can see from this chart, US GDP in PPP terms was a very large share of global output in 1950. It has declined, but at that time, the US was clearly the dominant economic power. And you can see the growing importance of the US dollar in international reserves, not necessarily because of switches among reserves, but because many countries just needed to build up reserves, and they built up reserves of the key currency, which was the dollar. But even during this period, which we look back on as a period of recovery, growth, development, there were pressures on the US in terms of trade-offs between domestic and global imperatives. And the US did pressure its allies at times. The US did not always deploy its hegemonic power in ways that were acceptable to everyone. One case of naked deployment of power was Eisenhower's blocking of IMF credits to the UK, forcing them to withdraw from the Sinai during the Suez Crisis. Now, of course, this was in response to a UN resolution, so it was multilaterally popular, but still, it was a pretty strong use of financial force. The gold problem, the Triffin problem, became important. And if you go back to 1961, just weeks after being inaugurated, President Kennedy addressed Congress and pointed to the need to reduce US defense expenditures abroad for balance of payments purposes. Interestingly, he proposed that Congress pass legislation that would allow banks and others to pay a higher rate of interest to foreign official holders to keep them from converting gold, while allowing lower interest rates for other domestic residents to support the economy. And this is pretty much the opposite of what the head of the Council of Economic Advisors suggested last November, which was to tax foreign official holdings. Another important case was the trilateral negotiations, the UK, the US, and Germany in 1967 about reducing troop deployments in Germany. Essentially, Carl Blessing, the head of the Bundesbank, and William McChesney Martin, the head of the Fed, negotiated a letter in which Germany basically agreed not to convert their dollars into gold, worrying about US security commitments. President Nixon in 1969 called on allies to reduce their defense dependence on the US, to buy more US armaments. And of course, in 1971, there was the Nixon shock, which led in a couple of years to the floating exchange rate system. The 1970s were a decade of enormous transition and change, and we remember it in part for the very, very high inflation of that period. This chart puts that inflation in perspective compared to the recent bout of inflation. In the regime of floating exchange rates, the US liberalized its capital account. This was partially in the hope of weakening the dollar, but this was something that was not generally supported by all international partners. The US went ahead. And one effect of this was to integrate the onshore dollar market with the very extensive eurodollar market that had grown up by the early 1970s. And this left the dollar in a very, very strong position as an international currency. No other currency could compete on these grounds. Of course, OPEC found its power in this period, an important change in the power dynamics in the world. And the status of the dollar was contested in the sense that the very high inflation led reserve holders of dollars to want to avoid their currency risk. The fund advanced a proposal to have all holders of dollar reserves convert these into SDRs, leaving the IMF holding the dollars. This was called the substitution account proposal. The US was actually not opposed to this because the US had doubts about the role that the dollar had played under Bretton Woods, the constraints it had been under, and didn't really want to reprise that situation. But the account proposal failed, essentially because it couldn't be agreed who would be responsible for losses if the dollar depreciated further. Very importantly, in terms of the structure of the international system, in the mid-70s, we saw the start of the Basel Committee process via the BIS, the process of central bank supervisory coordination in an environment where financial stability risks were becoming more apparent. Further transition occurred during the 1980s. Paul Volcker tamed inflation, of course, and inflation came down throughout the world. There were actually upsides for the dollar from Ronald Reagan's fiscal deficits. Coupled with the Volcker conquest of inflation, these two macro policies led to a very sharp appreciation of the dollar. I would call it an epic appreciation of the dollar, which certainly moderated the desire of reserve holders to get out of dollars. I would argue also that Reagan's deficits provided the world economy with a large supply of safe dollar assets at a time when the dollar was just getting stronger, and that this also promoted the dollar's global role. But if you look back to that chart I showed you of reserve growth, you'll see that it wasn't really until the end of the 80s that the dollar really started rising from its lows as a reserve currency. Other actions solidified the dollar's position, increasing financial liberalization and market orientation in the US, which spread worldwide, including to China, the strong US commitment to markets and the rule of law. All this set the stage for this dollar resurgence, and the end of the Cold War put an exclamation point on all of this as the US became the world's sole hegemon and the hyper-globalization period kicked in. Let's look again at Andrew's three characteristics and think about how the 1990s period looked. There was a new economic framework in place. The dollar became actually more central than ever contrary to predictions in the early 70s that its role might be diminished. Hyper-globalization took the form of growth in trade, but also a hyper-globalization of capital markets, growth of supply chains, and all of these reinforced the need for a single global currency. Emerging markets joined this trend and benefited considerably. We saw considerable convergence throughout the world economy. The world was quite peaceful. And I would argue, looking back on this, not that I want to criticize the idea of world peace, but in a world where there are not external threats, I think governments may downplay excessively the need for domestic social solidarity. And in some countries, certainly in the US, social solidarity took a backseat to globalization. And this led to a process in which some were left behind. And it's a process of which, to some degree, we're reaping the dividends today. New institutional structures emerged as well. The WTO was created, expanded country participation in the Basel process and in membership in the BIS, and this is something that Andrew Crockett sponsored, and it was natural for him to do so given his background at the IMF. The Financial Stability Forum, initially chaired by Andrew, was created. More regularized multilateral consultation came into being, and there was a maturing IMF role in capital account crises in this period. And there was a new distribution of power in the system. The US was the sole hegemon, but everyone cashed in on the peace dividend. And I think it's fair to say that emerging market influence grew as the former Soviet bloc entered the world economy. And certainly the European community raised its game through the Maastricht Treaty and the euro, leaving the dollar still reigning, but leaving a much stronger European framework in place. To discuss the last 25 years, I would really have to delve into political science, and sociology, not just economics. It's not my comparative advantage to analyze or to summarize this, and this is a history that we've all lived through and that we're familiar with. But I would point to a number of institutional changes, some of them not positive, most positive, but the G20 process, the extended swap lines that grew out of the global financial crisis, the Financial Stability Board growing out of the forum, Basel III, but also the degradation of the WTO, partly at the hands of the United States. And there are obvious changes in the distribution of power. The rise of China has led to declining US hegemony. It has led to more US ambivalence in supplying global public goods. Internal political developments have also changed external behavioral norms and have changed the power balance and the way that power is exercised. One change in the power structure since the late 1980s, which I think is quite important and may be in question in the future, is it's hard to deny that there has been a shift in power toward the central banking community in general, with the spread of central bank independence and the spread of the culture of central banking, which has yielded incredible success in bringing inflation down to moderate levels throughout the world. I mean, if you look at this chart and you see where we were through the end of the 1990s, certainly in terms of emerging and developing economies, the evolution has been remarkable, and this in part reflects the spread of an accepted culture of central banking around the world and the political independence that has been ceded to central banks. So I think this is a major change in the power distribution. And this obviously has implications for the way the international system, including exchange rates, function. The international monetary and financial system today, I would maintain, is at a fork in the road. One handy summary statistic of this, if you will, is the dollar as a way to think about fragmentation risks more generally. I would maintain that the current policy settings of the Trump administration could gradually undermine the dollar's advantages and fragment global markets. I wouldn't see this as something by any means that happens overnight, but as a sort of process that is just pushed along by a sequence of political shocks of various kinds. I think one force that will lead to fragmentation is countries simply wanting to insulate themselves from economic coercion through less integration with the US economy. Tariffs that reduce US trade will diminish the dollar's role inevitably. Pressure on the Federal Reserve is likely, if it gets any traction, to be inflationary, to weaken the dollar further. I think that's part of what we're seeing today in the dollar's behavior. And worrisome for me is that the administration in the US has seized considerable control over the financial regulatory function of the Fed. And for me, and I think for many in this room, it's very hard to separate that intellectually from the monetary policy function. And it's also hard to know how this would work out in many practical settings. It could involve a pullback from international regulatory cooperation. It could lead to the conditionality or absence of swap lines. I think the fiscal path that the US is on, and of course the Senate yesterday just passed their part of the One Big Beautiful Bill Act, is really in danger of leading to fiscal dominance. The Senate version of the bill adds even more to the US debt by 2034 than the House version, perhaps as much as $1 trillion more. I do believe there's a risk of US capital controls of some sort. We saw the discussion over Section 899. We have in the legislation going through Congress taxes on remittances. I think there's a chance that when the tariff policy fails, as I believe it will, to reduce trade deficits, the next target might be in the capital account. I think fragmentation can come from looser enforcement of various rules, such as on money laundering and bribery. I don't want to return to the stablecoin discussion, but I do think that the U.S. eagerness to push the stablecoin onslaught as a means of business opportunities and also preserving dollar dominance causes a challenge for other countries, particularly emerging markets where monetary sovereignty would be threatened, but also I think there are other threats around financial stability and around just the integrity of the system that was mentioned this morning in the presentation. All of this could lead to fragmentation of the cross-border payment system, particularly if the remit of the executive order on reducing the Fed's independence concerning financial policy is held to extend to international payments matters. Generally, the US retreat from providing global public goods is bound to also hurt the dollar. We've seen in recent episodes situations where in response to a global shock, and I'm thinking of the Liberation Day tariffs, the dollar has depreciated while treasuries have risen. The favorable risk premium on treasuries, one of the things that makes them attractive as a reserve asset is the ability of reserve holders to sell them in a crisis and sell them into a market where yields have fallen and the dollar is stronger. If this is a durable change in patterns, then this would make the dollar less attractive as an asset. So this chart basically shows the behavior of interest rates in the dollar since November of 2024, shortly before the election. And some of these events are notable. The strong depreciation of the dollar is notable. And I would also note that the CDS price for treasuries rose around the debt ceiling discussions in 2023, has remained high, spiked up again around the Liberation Day announcements. I think there are definite signs of trouble in the market. They're not all uniform. It's hard to read the market sometime, but it's also hard for me to be comforted by what I see. We've also seen wide-ranging attacks on, let me take that back, U.S. institutions. And to give the entire list of things that we're seeing, it would be like reciting the plagues of Egypt. But I would just mention a couple of things that worry me particularly. One is the attacks on legislators, on the legal system, on state governments. I worry about the attack on norms around self-dealing in public life. I think that's a major problem. And something that Adam Posen brought up yesterday that I think is a real problem is the degradation of data collection by the U.S. government. This has been a gold standard. Much economic science was pioneered in the course of developing these statistics, and to take these data away so that businesses and the government are flying blind, I think is totally irresponsible. We owe a lot of the U.S. institutional structure to Alexander Hamilton, and so I quote his report on public credit from 1790. He said that states, like individuals who observe their engagements, are respected and trusted, while the reverse is the fate of those who pursue an opposite conduct. And I think part of the reason for the success of the U.S. over the long term has been its aspiration, not always met, but still an aspiration, to create institutional anchors that push it toward Hamilton's ideal, to have a strong rule of law, trust in institution, trust in promises. But as Andrew Crockett observed in 2000, anchors are no better than the ground in which they are planted, and that ground could at worst turn out to be quicksand. Where are we headed if there isn't an about-face with the US? Well, let's come back to Andrew's three characteristics. I think we're headed toward more segmentation in trade and finance between the US and the rest of the world. US is clearly abandoning the most favored nation principle and non-discrimination, and unfortunately it's dragging some countries along with it as they make bilateral deals. I think the US, for various reasons, is headed to lower long-term growth and possible inflationary and fiscal instability. And how this will spill over to the rest of the world will depend on the rest of the world's ability to pull together and cooperate, because there could clearly be very negative spillovers if shocks emanating from the US lead to more discord among other countries. Institutions of the global economy may have to evolve increasingly through coalitions of the willing. The current structure of international financial institutions may turn out to be unsustainable, even if the US doesn't withdraw. And this is my last point. I think the US ultimately is going to have less power in this system, not just soft power, but hard power as countries draw away from it. Its influence will be greater the more disunited is the rest of the world. Europe, I believe, has the potential to raise its influence significantly, and a number of you in this room have been pointing that out. And I would say that unity in the rest of the world, even if the US is not part of that, is imperative. We are in a much more fragile and connected world than we were 100 years ago, with the threats of climate, nuclear proliferation, and disease. And there are still great benefits to cooperating, even if the US is out of the picture for a while. I'll stop there.